to do it. We kind of got started with the euro currency market and talked about the issues with the old reference rate LIBOR. Now that it doesn't exist, there are quite a bit of alternatives. You know, nice thing about LIBOR was it was essentially a rate for short-term loans among banks that was unsecured. Now, for at least USD transactions, we have kind of a reference rate called SOFR, which is short for Secured Overnight Financing Rate. This is essentially overnight rates, but they're collateralized by some sort of security, treasury bonds, commercial papers, T-bills, what have you. New York Fed actually publishes summary values of these. If you type New York Fed SOFR rates, it's going to get you a link. I'll actually put this in our notes. Now, this is the overnight rate. And if you want to calculate rates for longer maturities, you can kind of calculate it by daily compounding. I think you could also do it from here. Let me see. You can actually get the data for these. For example, let's do it over the last 3 months. And you can download this to an Excel file. You can, of course, sort it by rate type. And I'm going to do a data filter. I'll just pick the software. I don't know why they're not calculating the averages, but they should. I mean, currently overnight rate is about 4.4%. these are going to be actually useful when we talk about short-term interest rate management. We're going to use SOFR futures. They're based on kind of backward-looking numbers. So we need to do some hanky-panky with the Excel, but at least, we have the backward-looking data for that. Unfortunately, it's less than ideal. Oh, I should have picked these. Anyway, we'll take care of that. Because the old euro dollar futures contracts were simple. They were for 3 month future LIBOR rates. Now it became a little bit more complicated, but I'm going to actually set up a template for that outside of the class when we get to that. Because there's not too much point of spending valuable class time on niceties of Excel. I mean, this was a upper level required finance class. I would have done this, but this is open to both finance and general business or international business majors. So I'm not going to do all of that. But this market is, rather big. If you look at the external liabilities of international banks, as of 2021, we're talking about $27 trillion. That's bigger than GDP of Japan, I think. Maybe close to GDP of US as well. And but about 60% of that is liabilities of banks to each other. That also kind of highlights the role of financial contagion when there are crises. I mean, these banks owe each other about $16 trillion, right? So if one of the large international banks go down, that means a lot of big international banks are going to be affected by that. And that means it could create kind of a snowball effect. Now, there's also so-called Euro credit markets. These are, again, credit markets where loans are in US dollar terms or, whatever the currency of that country. I mean, you can be a Euro credit country. Loans are in Japanese yen terms, but outside of Japan. That would also be a Euro credit kind of market. Where firms actually borrow in short to long term, but typically such loans are kind of done by groups of banks. We call it a syndicate. So let's say I'm Deutsche Telekom, and I want to invest into some new technology, fifth generation, sixth generation, whatever it is. Of course, I need a lot of money. So what do? I go to the Euro credit market, and I may choose maybe Deutsche Bank as my lead manager, and I tell Deutsche Bank I want 10 billion euros for this investment. More than likely, Deutsche Bank is not willing to lend $10 billion to one customer. Because if they don't pay it, they're going to be in trouble. So they kind of start syndicate together. They tell other big banks, Deutsche Bank wants to borrow 10 billion euros. Any of you guys are willing to participate in the syndicate? And JP Morgan comes and says, I can do up to $500 million. Bank of Tokyo Mitsubishi comes and says, I can do 2 billion, whatever their credit limits for that company. You put it together, and the lead bank typically gets a bigger commission out of this, because you're originating this. It's similar to real estate brokerage. The broker that actually sells the house gets 3%. The broker that came up with the listing, even if they don't sell it, they get 3%, something like that. So the lead bank is technically the one that has the listing. And these are rather common. And more often than not, these loans are floating rate loans, which means they pay quarterly interest rates, and the interest rate that is paid is not fixed. In the old days, it used to be LIBOR based. So depending upon the credit rating of the firm, Deutsche Telekom probably is a AAA rated firm, which means these days they would get about LIBOR plus half point. Okay. If you're single A, maybe LIBOR plus 1 point, something like that. In fact, we can look at those spreads in the United States. But if the short-term interest rates are on the rise, that means you are going to pay higher, you are going to make higher interest payments in the future. And we have means to hedge those, which we're going to talk about in chapter 14. In fact, after next week, we're going to talk about international bond markets, which is chapter 12. Then I'm going to skip 13 and go to 14. 14 is how to manage interest rate exposure in single or multiple currencies. From that, you guys are going to get an extensive homework assignment. Now, sometimes to manage the interest rate risk, if you want to do this with a counterparty, you can get into forward rate agreements.